Nvidia just delivered another earnings report that sent ripples across Wall Street and the tech world. A massive $39 or $33 billion in revenue last quarter, beating estimates by nearly $1.2 billion. This wasn't just a beat, it was a statement. But what does this truly signify for the future of AI, for the market, and for your investment perspective? Let's dissect the numbers and look beyond the headlines. Let's cut straight to the core figures that define this quarter's performance. For Q1 2025, Nvidia reported an impressive earnings per share, EPS, of $0.89. This figure comfortably surpassed the analyst consensus estimate of $0.85, representing a solid 4.96% beat. The top-line number, revenue, was even more striking. Nvidia posted a staggering $39 or $33 billion in revenue for the quarter. This significantly exceeded the forecast of $38.10 billion, demonstrating robust demand across their key segments. Comparing this performance to the same period last year reveals the true scale of their growth trajectory. In Q1 2024, Nvidia's revenue stood at $22.1 billion. The $33 billion reported this quarter represents an astonishing 78% year-over-year increase in top-line growth. This level of acceleration is almost unprecedented for a company of Nvidia's size. It underscores the explosive, ongoing demand for the foundational technology powering the artificial intelligence revolution. These numbers aren't just financial metrics. They are indicators of a fundamental shift in global computing infrastructure. Furthermore, this report reinforces Nvidia's dominant position across the entire AI ecosystem. They continue to lead not just in silicon design, but also in the software and networking layers essential for deploying large-scale AI. Their full-stack approach provides a significant competitive moat. The consistent outperformance suggests that the market's appetite for AI compute power remains insatiable. This is a critical point for investors and analysts assessing the sustainability of Nvidia's growth narrative. The demand signal is clear and strong. Understanding the why behind these extraordinary numbers is crucial for a complete analysis. The primary engine driving this performance is the relentless, explosive demand for AI infrastructure. This isn't a fleeting trend. It's a fundamental transformation of computing. Nvidia's Hopper architecture, particularly the H100 and the newer H200 chips, remains the gold standard. These processors are the backbone powering the most advanced AI models and applications globally. From training cutting-edge large language models like those used by OpenAI to enabling hyperscale data centers for tech giants like Meta and Google, Nvidia's silicon is indispensable. Beyond the hyperscalers, Nvidia is strategically expanding its footprint into enterprise and edge AI markets. This diversification is a key factor in sustaining long-term growth. Businesses across various sectors are now looking to deploy AI for efficiency, innovation, and competitive advantage. Partnerships like the one with Foxconn to build AI factories and supercomputers are critical. They demonstrate Nvidia's ability to enable AI adoption at scale across different industries. The recent release of the 72 billion parameter NVLM AI model further showcases their commitment to pushing the boundaries of AI capabilities and providing ready-to-use solutions. These initiatives are not just about current sales. They are about future-proofing Nvidia's leadership. By embedding their technology deeper into the enterprise and edge, they create new revenue streams and strengthen their ecosystem. This strategic foresight is vital for maintaining their market position. Analyzing their operational efficiency provides another layer of insight. Nvidia boasts a market capitalization exceeding $3.5 trillion, a testament to investor confidence. Their revenue per employee stands at an astounding $4.1 million. This metric highlights exceptional productivity and operational leverage. Comparing this to other tech giants like Apple, Amazon, or Google reveals Nvidia's unique efficiency profile. It suggests a highly focused, high-margin business model centered around intellectual property and specialized hardware. This efficiency contributes significantly to their profitability and ability to reinvest. The combination of overwhelming market demand, strategic expansion into new segments, key partnerships, and exceptional operational efficiency paints a clear picture. These factors collectively explain the robust performance and provide a foundation for continued growth, albeit with careful consideration of potential headwinds. Looking ahead, Nvidia has provided guidance for the second quarter of fiscal year 2025. The company expects to report revenue of approximately $43-34 billion. This forecast, while representing continued growth, also sets a high bar for performance. Interestingly, the guidance for earnings per share, EPS, is forecasted at 0.73 for Q2. This projection indicates a potential sequential dip in EPS compared to the 0.89 reported in Q1. This might initially seem counterintuitive given the revenue growth. However, this expected dip in EPS is largely attributable to significant planned reinvestments. Nvidia is heavily investing in the development and ramp-up of its next-generation architecture, Blackwell GPUs. These chips are designed to deliver even greater performance for the increasingly complex demands of AI workloads. Furthermore, substantial investments are being made to expand their AI services offerings. This includes cloud platforms and software solutions that complement their hardware. These investments are crucial for building a sticky ecosystem and capturing more value across the AI stack. Scaling production to meet the soaring global demand also requires significant capital expenditure and operational investment. Building out supply chains and manufacturing capacity is a complex and costly undertaking. These strategic investments are necessary to maintain market leadership and capitalize on future opportunities. Despite the potential short-term impact on EPS due to these investments, the projected $43-34 billion in revenue for Q2 would still mark another record quarter for the company. It signifies continued top-line expansion. Given Nvidia's history of exceeding its own guidance, there is an optimistic possibility they could beat this forecast as well. However, analysts and investors will be closely watching the execution of these investments. The successful transition to Blackwell and the efficient scaling of production are critical factors for future performance. The balance between aggressive investment and maintaining profitability is a key aspect of Nvidia's financial strategy moving forward. This outlook underscores a period of intense strategic activity for Nvidia. They are not resting on their laurels, but are actively investing to solidify their future dominance in the rapidly evolving AI landscape. The Q2 results will provide further clarity on the pace and impact of these initiatives. Despite the undeniably strong fundamental performance, Nvidia's stock experienced a slight dip of 0.3% in after-hours trading following the earnings release. This reaction might seem perplexing given the significant revenue and EPS beats. It highlights the complex interplay between strong results and elevated market expectations. Why the muted after-hours reaction? In the high-stakes world of AI stocks, particularly Nvidia, expectations are often stratospheric. Investors might have been anticipating an even larger beat, perhaps hoping for a guidance raise that was significantly above the already high forecast. The market sometimes demands fireworks, results that don't just beat but utterly shatter expectations. This phenomenon underscores the challenge for high-growth companies like Nvidia. Delivering excellent results is no longer enough. They must consistently exceed an ever-rising bar set by optimistic investors. The slight dip could be interpreted as a momentary pause or profit-taking after a significant run-up in anticipation of the report. Despite this immediate market reaction, the broader sentiment among professional analysts remains overwhelmingly positive. Out of 63 brokerages covering Nvidia, a remarkable 57 currently rate the stock as a buy. This high proportion of positive ratings indicates strong conviction in the company's long-term prospects among institutional analysts. The median price target among these analysts stands at $165. With the stock currently trading around the $140 level at the time of this analysis, this median target suggests a potential upside of approximately 17% from current levels. This provides a quantitative measure of analyst optimism regarding the stock's future valuation. The underlying driver of this positive sentiment is the continued, robust demand for AI chips. This demand shows no signs of slowing down in the near term. As AI adoption accelerates across industries, Nvidia remains the primary beneficiary due to its technological leadership and established ecosystem. Considering the strong fundamentals, the dominant market position, and the positive analyst consensus, NVDA remains a top contender for investment consideration in 2025. While short-term price movements can be volatile, the long-term thesis driven by the AI revolution appears firmly intact. Investors should weigh the analyst targets against their own risk tolerance and investment horizon. While the outlook for Nvidia appears bright, a balanced investment analysis requires acknowledging potential risks alongside the catalyst for growth. No investment is without its challenges, and Nvidia faces several factors that could impact its trajectory. One significant risk is increasing competition. While Nvidia currently holds a dominant market share, competitors like AMD and Intel are actively developing their own AI accelerators. Furthermore, the rise of custom silicon developed by hyperscalers, like Google's TPUs or Amazon's Inferentia, and the emergence of Chinese chip makers pose potential threats to Nvidia's market share over the long term. Geopolitical headwinds also present a notable risk. Export restrictions, particularly concerning advanced AI chips to certain regions, could impact Nvidia's sales and market access. The complex global political landscape adds a layer of uncertainty to international operations and supply chains. Another point of caution is the stock's valuation. With a forward price-to-earnings (PE) ratio currently exceeding 36, Nvidia trades at a premium compared to many other large-cap technology companies. While justified by its high growth rate, a high valuation can make the stock more susceptible to significant pullbacks if growth slows or market sentiment shifts. However, the catalysts for continued growth are equally compelling. The most significant catalyst is the projected explosion in global AI spending. Forecasts suggest that worldwide spending on AI is expected to exceed $2 trillion in the coming years. Nvidia is uniquely positioned to capture a substantial portion of this massive market expansion. Government contracts represent another potential catalyst. As nations prioritize AI for national security, defense, and cybersecurity, Nvidia's technology is likely to be in high demand for government-led initiatives and infrastructure projects. This provides a potentially stable and significant revenue stream. Nvidia's strategic expansion into new, high-growth markets like autonomous vehicles and edge computing also serves as a powerful catalyst. The need for AI processing power in cars, factories, smart cities, and IoT devices is immense. Nvidia's platforms are well-suited to address these diverse and growing applications, opening up vast new addressable markets beyond traditional data centers. Balancing these risks and catalysts is essential for investors. While competition and geopolitical factors require careful monitoring, the overwhelming tailwind of AI adoption and Nvidia's strategic positioning in multiple high-growth sectors provide strong support for the bullish case. A cautious optimism, grounded in a thorough understanding of both opportunities and challenges, is warranted. Turning to the technical picture, a look at the stock chart on platforms like TradingView provides valuable insights into recent price action and potential future movements. NVDA has shown strong momentum, recently breaking through a significant resistance level around $140. This breakout is often seen as a bullish signal by technical analysts. Following the breakout, the stock tested the next key psychological and technical level near $144. Holding above the $140 level is crucial for maintaining bullish momentum. A sustained move above $144 could open the door for further upside. The next significant psychological target for the stock is the $150 level. Reaching and consolidating above this mark would be another positive technical development. If the upcoming Q2 results are strong and the overall market sentiment remains favorable towards AI stocks, a move towards the analyst median price target of $165 or even $160 by mid-year does not seem unrealistic from a technical perspective. However, it is important to consider potential downside scenarios. A correction in the broader market or specific negative news related to Nvidia could lead to a price decline. A break below the $135 level would be a bearish signal, potentially bringing the stock back towards its 50-day exponential moving average, EMA. The 50-day EMA, currently sitting near $128, often acts as dynamic support during uptrends. A test of this level could represent a buying opportunity for those looking to enter or add to their position, provided the fundamental outlook remains strong. Conversely, a decisive break below the 50-day EMA could signal a deeper correction. Technical analysis provides a framework for understanding market sentiment and potential price movements, but it should always be used in conjunction with fundamental analysis. The strong fundamentals discussed earlier provide the underlying support for the bullish technical picture, but market dynamics can change rapidly. Monitoring these key price levels and volume trends will be important for investors tracking NVDA. Nvidia's latest earnings report unequivocally demonstrates its continued dominance in the artificial intelligence market. The numbers are not just impressive. They reflect a company operating at the epicenter of a technological revolution, with robust demand translating directly into exceptional financial performance. Nvidia is, for now, still the undisputed king of AI infrastructure, and the recent results provide ample evidence to support that claim. However, with great success comes heightened scrutiny and elevated expectations. The market's reaction, while slightly muted after hours, underscores the incredibly high bar Nvidia must clear with each subsequent report. Maintaining this pace of growth and profitability will require flawless execution, particularly as they navigate increasing competition and invest heavily in future architectures like Blackwell. The path ahead involves both immense opportunity and potential challenges. The insatiable global demand for AI, coupled with Nvidia's strategic expansion into new markets and its technological leadership, provides a powerful tailwind. Yet, investors must remain cautious of valuation risks, geopolitical factors, and the ever-present threat of competition. A balanced perspective, acknowledging both the optimistic growth narrative and the potential headwinds, is crucial for informed decision-making. What are your predictions for Nvidia's Q2 performance? Do you believe they can continue to smash records, or are the expectations simply too high? Please share your thoughts and analysis in the comments below. If you see Nvidia as a key player in the future of AI and support their vision, give this video a like. And for more in-depth analysis of earnings reports, market trends, and the companies shaping our future, remember to subscribe to our channel for weekly insights.